What will you do when your money works for you? Welcome to the TechGirl Financial podcast with your hosts, Victor and Kim Gaxiola. From the home office in California, here is Victor and Kim.
And welcome back to the TechGirl Financial podcast. It has been a while since we've recorded a podcast, and it's exciting to be back.
It is great to be back, sitting here in our studio and continuing with our pledge for a summer of education.
Yeah, speaking of which, summer of 2024. It's already been a pretty eventful year. We've got a new graduate in the house. Our son, Noah, graduated from high school here in June and is heading off this fall to San Diego State University. So we're real happy. For those of you that may be listening from San Diego, can't wait to spend a little bit more time down there.
Me too. Go Aztecs.
Yeah, go Aztecs. So we'll be spending a little bit more time. That means we're going to be empty nesters, which is kind of an exciting new role for us.
It is mostly exciting. A little bit, we'll see how it goes, right?
Yeah, well, I think we're going to be able to get some more travel in. So we're already planning, for those of you that might be listening in the Midwest, we got a Midwest tour plan, which means we're going to get to not only spend more time with clients, but while we're there, actually get to enjoy being in the place.
Right, and that I am looking forward to. Not as big of a rush, right?
Yeah, exactly. Not rushing to get back for anything, really.
Mm-hmm.
The pets, maybe, but they can probably fend for themselves. So speaking of 2024, we thought we'd, start and kick off this first podcast just with kind of like a catch-up. It's been a while since we last recorded one, and thought we'd share a little bit about our views on the market, especially the conversations we've been having with many of our clients over the course of the spring leading up into the summer, as we reflect a little bit on the changes that we're seeing both from an economic standpoint, but also the reflection now on the financial markets.
Right. This is probably the first time in a long time that I've felt like here I am saying we're going to have a recession at some point in the future and feeling like a broken record, right?
That's exactly what it feels like. It does feel like a broken record. It's funny because at the beginning of the year, Kim and I, as a two-person investment committee, investment committee, get together and we talk a little bit about what our expectations are for the year. And a lot of that is a collective of the people that we follow, the different portfolio managers, certain economists. Everybody has an opinion as to what they think is going to happen. A lot of that is based on experience. A lot of that based on data. A lot of that is based on, the looking at what other forecasts have done and things that have done in the past. Now, we often say in this business that past performance is not necessarily indicative of future performance. However, there are patterns that you'll start to see that will present themselves so that when you have a recession, certain things happen. When you have an expansion, certain things happen. And so in looking at 2024, after coming off a very robust 2023, the conversations we were having with clients was one that we were expecting a lot of cooling in the financial markets, and a lot of that driven by the fact that at some point we were expecting some kind of slowdown.
Right. And always remember that there's two different slowdowns that tend to happen. There's one that's slowdown, which is the economy, and one slowdown, which is the market. Mm-hmm. And right now, I don't think anybody can say there's been a slowdown in the market. It's actually been pretty hot. But we do remember back in 2022 when the market did fall quite substantially. And so want to make that painful memory come back, because now there seems to be a little bit of a euphoric energy that stocks can go up, up, and up, and up. And that tends to scare me very much. And then we have the economy, which I think this is why so many are confused. Maybe they look at their 401k statements and they look great, but at the same time, they're looking at their bank accounts and their cash flow is pretty tight, and they're not feeling that everything is rosy.
Mm-hmm. Yeah, it's sometimes, very interesting how certain reports, certain data, certain things that we see may not necessarily feel like it's being reflected in what you're seeing out there. So case in point, when you start talking about, there's a slowdown happening, people are tightening their belts, they're not spending as much money, and yet you go and restaurants are full and people are traveling. So sometimes like the data doesn't seem to be reflecting in the reality, But then again, you don't know what's happening behind the scenes in people's, checking accounts. Maybe they're not holding as much as they were before. Maybe they're putting a lot on credit cards. So there's a lot of things that you may not know that as people try to maintain a specific lifestyle, it's hard to know what might be happening behind the scenes.
So it's really puzzling. We can look at different types of activity in the economy and try and figure out where we are. And this is why things are so puzzling, is some numbers are up one month and then down the next.
Mm-hmm.
I would say if we look at consumer activity, business activity, and financial activity, I just see if we were to do this as a red, yellow, and green light means yay, we're expanding. Red light means we're going down, and yellow light is caution.
Mm-hmm.
I see a lot of yellow lights.
Mm-hmm. Yeah, there is. And I think that this cautionary approach both to the market and looking at different facets of it is exactly what the Federal Reserve has really been challenged with. When you look at interest rates, they try very hard to maintain a certain stability, and that's why they've been pausing any interest rate hikes lately. Now, a lot of the interest rate decisions by the Fed have been driven by their fear of inflation. Right. And so far as saying, we don't feel comfortable cutting rates just yet because we still see that the inflationary numbers are strong. We're still seeing that the employment picture seems to be strong. And so, very early on, one thing I think we did get right is that, we were going to be prepared for those interest rates remaining higher for longer, and that they are likely to be cut, but we kept pushing that back further and further into 2024. And at this point, there's a lot of people that think there may not be a rate hike this year, that we may not see it until 2025.
I'm really skeptical of that because I think we have an election coming, and I think that there are some politics and shenanigans going on. So I would say, if anything, I think maybe there's one rate cut this year, but That's it. So since you've already brought up rate cuts, maybe we should talk about the financial indicators first. And because that's what we're looking at is the yield curve and, what's happening in the bond market, the money supply, are we tight or loose, and credit spreads, which is looking at individual types of bonds and if there's a big difference between low credit rating bonds and high credit rating bonds. And so I would just say, if we had a yellow light, those are three different categories: credit spreads, money supply, and yield curve. And two of those, money supply and yield curve, are indicating we're in a recession, but credit spreads are indicating we're in expansion. What gives?
So how do you interpret something like that from the standpoint of, should I feel good about that, or should I be concerned because I'm getting mixed message?
I know it is. That's why everybody is confused. But I would say, money supply and yield curve are more looking to the future, whereas credit spreads may be a delayed indicator. And because if you're talking about lower quality companies versus higher quality companies, and we haven't hit a recession, those companies are still in good shape. Mm-hmm. It's when things go into recession and some of those companies start really doing poorly that you would see a tightening or a loosening up of the credit spreads. And so we're not seeing that yet. Maybe it's just a delayed reaction. But, I just go with simplistics and say we've got two recession indicators and one expansion indicator. It's weird that the credit spreads aren't a caution indicator. It also could be that corporations are flush with cash still.
Yeah, and that's been my understanding. I mean, from the analysts that I listen to and taking a look at a lot of the large corporations in this country, they are holding on to a lot of cash right now. And so when you look at the money supply, I'm not surprised that is a recessionary indicator on the money supply, because I think people are holding money. Corporations are holding. I mean, there's still a lot of pent up, I'd say, demand, and people that are keeping cash on the sidelines, even on an individual level, not just a corporate level. I'm not sure what they're waiting for to put it back in the market. Perhaps they're waiting for those rate hikes, or the rate drops, I should say, or a cut that would at least anticipate the fact that that the market could get into that recessionary phase, which is then a good time to start moving more back towards an expansion.
One thing that's interesting, though, I will say, is that the only green light we have that is indicating expansion are in the financial markets, in the credit spreads.
Mm-hmm.
Everything else in business activity and consumer activity is all cautionary, with the exception of one indicator that is saying we're in a recession, and that is in consumer job sentiment.
Mm-hmm.
So why don't we break down business activity next?
All right.
And, all things lead to a yellow lights. And I just want to say, when we look at all of these yellow lights and compare them to where we were maybe in December of 2023, there was 50-50. We're in recession indicators and 50-50 in caution yellow light area. And so the different areas that we look at within business activity is we're looking at commodities. So all the things like gold and silver, copper, energy, what have you, anything that's sold as a commodity. We're looking at new orders, and that is looking at, corporations and what they're buying in the future. What are those new orders? Because that'll see whether we're in expansion or deceleration mode. We're looking at profit margins, of course, and truck shipments. And so if we looked at back in 2023, December of 2023, new orders and profit margins were showing us in a recession. Mm-hmm. And now those have improved actually a little bit, because now they're just like cautionary yellow light. Whereas truck shipments and commodities have been in yellow light cautionary areas for the past 6 months. Mm-hmm. So again, we're like, I don't know. Maybe the whole soft landing is happening. Is this what a soft landing looks like? We're just in yellow light territory.
Yeah. Now, is it possible that at some point, when we keep talking about these are recessionary, cautionary, or recessionary indicators, is it possible we could already be in a recession, but we wouldn't know it until, the third, fourth, fifth, or first quarter of next year?
Yeah, that's always the case. We never know when we're in a recession until after it's over. Mm-hmm. And, this is where I think back at the market really pulled back in 2022. And normally the market is a 6-month forward looker or forward indicator. And, it could be 6 months, it could be 12 months ahead of time. So was 2022 the pullback in the market that foretold a very mild recession in 2023 and 2024? Maybe we'll see that in the future. But we're still in the middle of the muddy times, and we just can't say it for sure.
Yeah, and then you add to this uncertainty, we're in an election year, which always, the markets don't like that uncertainty, not knowing exactly which of the two parties or the candidate will be in the White House effective in 2025 after the elections. Sadly, I think that we could be running into, once again, a contested election of some sort. From either side. And so you add that to the mix, and 2024 looks like a very difficult year for any real forecasting, which is one of the reasons why, and before we get into some of the consumer indicators, is one of the reasons why we've been sharing with our clients the importance of maintaining and holding quality, looking for large companies, looking for those that have strong balance sheets, that are producing a product or service that people are going to need, whether, the economy is doing well or badly, and just to weather the storm, if you will, until we start getting a little bit more of an indication and feel a little bit more confident about the direction we're headed.
Yeah, I would say so. I think there's a lot of speculation going on in the market right now, and maybe some of that market speculation is where they think the outcome of the elections are going, because I'm hearing a lot pointing towards the Republican side, right? And sometimes that is more of a business-friendly environment. So I don't know if that has anything to do with it. I don't want to go into the politics conversation today, but this could be some of the speculation going on in the markets. And but I'll tell you, when I see a lot of cautionary things, and as we move into the consumer sentiment and job sentiment, I I want to give a higher weighting to the fact that people are scared about their jobs, because those people are those people in the trenches that are firsthand seeing what's going on in companies. And so I feel like we need to give a lot of attention to the consumer activity and the job sentiment. And that's what worries me a lot.
Mm-hmm.
So we are seeing also, and it makes sense with consumer activity if we all look at the five buckets or 5 different indicators in consumer activity. That includes housing permits, job sentiment, jobless claims, retail sales, and wage growth. And housing permits, jobless claims, retail sales, and wage growth are all showing yellow lights, cautionary. And then we have one recession light, red light, which is job sentiment. This makes a lot of sense. If people are scared about their jobs, they're going to be a little tighter with their spending, or maybe a lot tighter with their spending. And there are a lot of people, I'm hearing more and more layoffs and people contacting us because they want help because they have the time because they've been let go. And so when I hear things like that, it is more indicative of a recessionary time. And so people are going to be tighter. We do know, we've heard before the statistic that a lot of people have the highest level of debt on credit cards right now. And so I would pay a lot of attention to consumer activity.
Absolutely. Well, in driving the buy-sell decisions, I go back to, like I said, you still see people who are traveling, but, that doesn't necessarily mean that it's as a result of the fact that they're flush with cash or doing well, or maybe that they have a job. You just don't know. But again, the theme here being caution. I had mentioned to one person, I can't remember who I was speaking to the other day, and I said that sometimes there's little indicators, and it doesn't even need to be data driven from a standpoint of the reports that we see or the reports that we read, but sometimes it's just looking around in your own neighborhood. And one thing that I noted in the last 3 months or so, maybe it started in the spring into the summer, I'm seeing a lot more like used cars for sale on the side of the road. I'm seeing a lot more for sale signs with homes. So when we start talking about the housing market starting to heat up again, and people getting to a place where they're waiting for interest rates to go down before they start making a move or making a purchase. Well, sometimes you can't wait, And so it's just little indicators like that, and taking a look at, what's happening in my neighborhood, what some of the activity that's taking place that could be an indicator of its own about where we're headed.
Yeah, that's so true. I always say it's important to ask local people what is going on. Although we do live in a little bit of a bubble here.
Yeah, it's true.
That's why I love to pull the people from all over the country.
Yeah.
But I would say, in general, I think we can say that consumers are preoccupied or worried across the country.
Yeah,
I do think so. I think there is a bit of a craziness with the stock market, and I also worry about that because, one contrarian indicator, I will say, is when people want to throw in the towel, throw in the good stocks and ignore those for all of the crazy high-flying stocks, and at a point when they think this stock can only go up, and up.
Yeah.
And that to me is when I feel scared we've hit a high.
Yes.
Doesn't mean it can't go higher, but how much higher? And you will never catch the top, but I tell you, you will not want to be selling at the bottom.
Mm-hmm. Yeah, and I think that we saw a lot of this, especially last year in 2023, leading to this year, when we talk about what was getting a whole lot of coverage last year was the Magnificent Seven stocks. So the Mag 7 stocks, which were mostly in technology, I think they're all in technology, but just for clarification for those that were unaware, the Magnificent Seven were Microsoft, Amazon, Meta, which is Facebook, Apple, Alphabet, which is Google, NVIDIA, the darling of the pack, and Tesla. And, so when you look at the S&P 500 returns last year, I think it came back at about 24%, 24.2 to be exact. That's what the S&P returned in 2023. Well, the biggest contributor to that was those 7 stocks, right? They were kind of like, you can't miss if you own these because they are contributing so much to the S&P 500. I think only 2 of the 7 actually pay a dividend, which we like. We like dividend-paying stocks. And a lot of that euphoria kind of carried over into 2024. But what it does is it level sets expectations for individuals. Because if you owned any one of the 7 or some of the 7, your portfolio probably did okay in 2023. So you start looking at 2024 with that expectation. And there is something to be said in our business, and it's called chasing performance, which is where you see something that's doing really well, and you continue thinking it's going to continue doing well. And so more money gets in, and of course, maybe temporarily, that may increase the price point of that particular stock. But eventually, fundamentals went out, and things could turn around, as you're saying. So again, proceeding with caution.
And again, remember, we don't have far to look back. 2022 did not feel good at all. The S&P was down about 20%, and the NASDAQ was down about 35%. Now, I can tell you right now, well, I couldn't tell you exactly, maybe you know, Victor, but what does the Magnificent Seven represent of the S&P 500?
Oh, it's large. I mean, I don't know the exact percentage, but when you look at the valuations of the companies, I mean, look at NVIDIA and Apple are constantly jockeying for which of the companies has the largest valuation.
Yeah.
So you've got 2 big heavy hitters there.
Yeah. You have to think like seven out of 500 companies in the S&P 500 index probably represent close to 20 to 30% of the index performance. NVIDIA went down 50% in 2022. So if we have a really, high flying Magnificent Seven, and they pull back, that's going to cause some pretty good damage to the S&P 500. And so I just caution, I'm grateful we don't invest in the S&P 500 because we don't have to do exactly what the S&P 500 does, and we didn't in 2022, which I'm glad. I'm not getting rid of my good stocks, my quality stocks, to buy a bunch of aggressive stuff.
Yeah, and I should note right here, just from a standpoint, this isn't necessarily financial advice. It's just basically observations that we're making on the financial markets based on conversations we've been having with clients. So we're not making any one recommendation on any one of these stocks. It's really just in general looking at the data and then trying to interpret the data to share with you all. So, where do we go from here?
I would say to end this podcast, I would say that, we are in yellow light territory, caution, caution, caution. And when the markets are acting very different than the economy, something is off, because nothing is efficient and nothing is always accurately positioned, right? The market doesn't always tell exactly where we are in the economy, and the economy doesn't tell exactly where we are in the market. But when you have things such a dispersion between the two, again, that means caution.
And so a lot of the activity that we've been doing in the spring has really been checking in with clients, checking in with people just to get a sense of where they are, what's their sentiment, how are they feeling, what's the outlook as far as their companies, their jobs, are they being promoted, are they seeing cuts? So there's a couple of activities that we're working on. One of them that we're excited about is looking at restricted stock units and the changes that are taking place in the market. We'll be sharing a little bit more about that in a future podcast. And one of the other areas, so we talk about silver linings in this. We haven't talked about this, but fixed income. fixed income actually is coming around. And so we're going to save a full podcast just to talk about fixed income and the enthusiasm that's been built around it ever since the third quarter of last year. Do a little bit more of a deeper dive, but that'll come up next in another podcast.
Yes, that will. And I will say, for those of you that are listening into this podcast and maybe feeling very nervous because you do own one of the Magnificent Seven and you've seen such a high increase in value of your net worth, congratulations. But also there are strategies that you can take to protect yourself. And that is something that we're working pretty heavily right now with clients. And so if this is something, if you're just listening to this, happen to come across us and want to hear more, I encourage you to get in touch with us.
Yeah, and I would encourage you that if you work at one of these companies in the Magnificent Seven, we'd love to talk to you just to get a little bit deeper dive as to what your feelings are and what's happening in your company, specific to the things that you might be seeing. We have a number of clients that work at some of these companies, and it's always just an eye-opener just to hear it directly from the people that are working there to get a sense of what might be happening behind the scenes.
Absolutely.
So again, it was so good to be back at the TechGirl Financial podcast. Just stay tuned. We've got a full season ahead of some very exciting programs, which will include new guests that are coming in. But as always, we're open to feedback. We're open to suggestions of any subject areas that you would like us to explore, and also anybody that you think would be good to have on the show. We'd be happy to hear about it.
Yeah. Thank you for listening.
So we'll talk to you soon. And remember, as always, our tagline is,
what will you do
when your money works for you? We'll see you soon.
Bye.
Bye.
If you have questions, comments, or suggestions for future shows, please send an email to victor@techgirlfinancial.com or join the conversation on Twitter using the hashtag AskTGF. We also encourage you to follow us on the TechGirl Financial page on Facebook and connect with us on LinkedIn.
Securities offered through registered representatives of Cambridge Investment Research, Inc., a broker-dealer member FINRA, SIPC. Investment advisory services offered through Cambridge Investment Research Advisors, a registered investment advisor. TechGirl Financial and Cambridge Investment Research, Inc. are not affiliated companies. Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions.